All right, get ready for a deep dive, folks. Today we're looking at IDFC First Bank in India. We've got a whole pile of earnings call transcripts, and honestly, it's a bit of a mixed bag. They're growing like crazy, but there are definitely some bumps in the road.
Yeah, it's interesting. Their business model at its core seems pretty solid. They're really focused on bringing in deposits and keeping their costs low, and they're also trying to build this tech-focused, customer-friendly platform, but it's almost like they're trying to build the plane while it's already flying.
It is, right, like
Mm,
building a skyscraper while
mm.
people are already moving in.
Yeah.
But yeah, let's talk about that deposit growth. It's seriously impressive. They're consistently hitting over 30% growth year after year. What's driving that? Is it just that they're offering better interest rates than everyone else, or is there more to it?
It's not just about offering the highest rates. You got to look at the bigger picture. Remember that CASA ratio we've talked about before? Current account savings account. It shows you how much a bank depends on, well, low-cost deposits. And IDFC First Bank, their CASA ratio is above 48%. That's a lot higher than a lot of their competitors. So it seems like they're doing something right to attract customers who want to keep their money there long term.
So it's not just about getting deposits. It's about getting the right kind of deposits, the kind that doesn't cost them a fortune in interest payments. That makes sense. And on top of that, they've actually managed to lower their overall cost of funds, like significantly, from 7.8% to 6.3% in just 5 years. That's a pretty big deal, right?
Oh, absolutely. It gives them an edge, when they're lending money because they're starting from a lower point. It shows they're being smart about managing their money, which is always a good sign.
All right, so we've got this solid foundation of low-cost deposits, and they're clearly pretty ambitious about building a, what do they call it, a diversified universal bank. But then we hit this but, and it's a pretty big but. The microfinance situation, this is where things get a little shaky, don't they?
Yeah, that microfinance portfolio is definitely a bit of a red flag right now. It's under a lot of stress, and that's having a knock-on effect on the bank's overall profitability. And obviously, investors get a bit nervous when they see that.
Right, and before we get into what exactly went wrong, maybe we should take a step back and explain what microfinance actually is, just for anyone listening who might not be familiar.
Sure, so microfinance, at its simplest, it's all about providing small loans and financial services to people who, well, might not usually have access to traditional banks. Think small entrepreneurs, farmers, people who need a little help to improve their lives.
So it's a really important part of the financial system, especially in a country like India, where a lot of people don't have access to regular banks. But in IDFC First Bank's case, it seems like something went wrong with their microfinance lending.
Yeah, unfortunately. They've pointed to a few different factors that led to more people defaulting on their loans. Some of it, was just bad luck, things they couldn't control, like there were those terrible floods and heat waves that hit parts of India. It made it really hard for people to repay their loans.
Right. It's like if you lend someone money to start a business and then a natural disaster comes and wipes them out.
Exactly. But they've also admitted that there might have been some internal challenges too, like maybe they weren't careful enough when they were deciding who to lend to.
So maybe they weren't as strict as they should have been when they were checking out the borrowers.
Yeah, it sounds like they were pushing hard to grow that microfinance portfolio really quickly. And maybe in that rush, there were some gaps in their process, like maybe they weren't fully assessing the risks. Some borrowers might have taken on more debt than they could actually handle, especially if something unexpected happened.
So a bit of bad luck, maybe some mistakes on their part, and now it's created this uncertainty around their earnings, which makes investors a bit jittery.
Yeah, that's right. Investors like to see some predictability, and these unexpected losses make it harder to figure out how profitable the bank will be in the future.
And it's not just the microfinance issue that's causing concern. There was also that whole thing with the toll road loan, right?
Oh, yeah, the toll road saga. That was a tough one. They had to write off a huge loan they had made to a toll road project. The state government decided to waive the tolls for vehicles. Basically, it cut off the revenue for the project, and IDFC First Bank was left holding the bag.
Ouch. Okay, so we've got two strikes against them, a microfinance crisis and a major toll road loan going bad. Anything else lurking in these transcripts that we should know about?
Well, there was a mention of a similar situation with a big corporate loan, though the details on that one are a bit fuzzy. It sounds like another instance of something unexpected happening that impacted their loans, and it raises questions about, well, their risk assessment again.
So maybe it's not just bad luck. It seems like there might be a pattern of these unexpected hits. Investors have to be wondering if the bank is really on top of things.
It definitely makes you wonder. And these events are adding to the concerns about their cost-to-income ratio, which is already pretty high. It's sitting at around 71%, which is, well, a lot higher than many of their competitors.
Okay, so let's break that down for a second. What does a high cost-to-income ratio actually mean? Like for the bank and its investors?
Basically, it means they're spending a lot of money for every rupee they earn in revenue. It could be a sign that they're not operating as efficiently as they could be, and that eats into their profits.
It's like running a marathon with a backpack full of rocks. You might make it to the finish line, but it's going to be a lot harder than it needs to be.
Exactly. It puts pressure on them to find ways to cut costs and become more efficient. They've said they're working on some cost-cutting initiatives, but it remains to be seen how effective they'll be.
So they're juggling these challenges with microfinance, unexpected loan losses, and a high cost-to-income ratio, all while trying to achieve these huge growth plans. That's a lot to handle.
Yeah, it definitely is. And it creates this tension, between their ambition and actually getting things done. Investors are starting to get impatient. The big question is, can they fix things and deliver on their promises, or are they going to get bogged down by all these problems?
Okay, well, we've definitely painted a picture of some big hurdles they're facing. But let's talk about the good news, because there has to be some, right? I mean, that deposit growth alone is pretty amazing.
Oh, for sure. That deposit growth is a definite win. It shows that customers trust them, and it's a strong base for all their lending activities.
And it's not just the amount of deposits. It's the type of customers they're attracting. An average balance of 3.5 lakhs for new savings accounts. That's not chump change.
Right, they're going after a more affluent customer base, and it seems to be working. These customers have more money to deposit, and they're also more likely to be interested in the bank's other products, like credit cards and wealth management.
So they're not just chasing numbers, they're going after customers who could bring in more revenue for the bank in the long run.
Exactly. And don't forget about their corporate lending either. Despite that toll road issue, their corporate loan portfolio is actually pretty clean. They've said they haven't had any new bad loans in that area for the past 5 years, which is pretty impressive in this economy.
Yeah, that's a good point. It shows they're not just throwing money at any project that comes along. They seem to be doing their homework when it comes to corporate lending, even if they did slip up with that toll road situation.
It does seem like that might have been a case of some unusual circumstances that were hard to predict. And speaking of trust and stability, they've also gotten some positive ratings from credit agencies. They even got a AAA rating for their fixed deposit program from CRISIL, which is one of India's top rating agencies.
That's huge. It's a vote of confidence from a reputable source, and it's got to make those deposits even more appealing to customers.
Absolutely. It tells the market that they're stable and reliable, which is especially important these days with all the uncertainty.
All right, so we've got this mix. Impressive growth, some definite missteps, and some solid fundamentals.
Yep.
So what's next? What's their plan to deal with all these challenges and still hit those ambitious profitability targets?
Well, that's what we'll dig into next. They've talked about tackling that cost-to-income ratio, getting the microfinance portfolio back on track, and continuing to build a diverse, strong business.
All right, well, consider me intrigued. I'm definitely ready to dive deeper into their strategy and see if they can actually pull this off.
Let's do it. There's a lot more to unpack here. It's a really interesting story about ambition, risk, and how the banking industry in India is constantly changing.
So we left off with IDFC First Bank, kind of at a crossroads. Great growth, but some serious issues they need to address. They've mentioned a plan. I'm dying to hear how they actually plan to turn things around. Where do they even start with that scary cost-to-income ratio?
Well, it's a multi-pronged approach, really. They've admitted that, expanding so fast has led to some inefficiencies, which makes sense. They've opened something like 1,000 branches in a very short time, so now the focus is shifting. It's less about just opening branches and more about making sure each branch is actually performing well.
Right, it's not just about being everywhere. It's about making sure each branch is actually making money. What are they doing to improve that branch efficiency?
Lots of different things. They're talking about potentially making some branches smaller, maybe even closing some, and moving towards, a more digital model and being more strategic about where they put branches, like focusing on high traffic areas. It's all about making sure their physical presence aligns with how customers actually behave.
Yeah, especially with their focus on tech-savvy customers.
Mm.
It makes sense to put more money into online and mobile banking, those kinds of digital channels. Less brick and mortar, more clicks and taps.
Exactly. And it goes beyond just the branches. They're really looking at their whole operational structure, starting with their tech spending. Think of it as a spring cleaning for their IT systems,
Mhm.
consolidating stuff, renegotiating contracts, getting rid of anything redundant to cut costs.
Streamlining. Love it.
Mm.
But let's be real. Cost cutting often means job cuts, which is never fun to talk about. Have they
Right.
said anything about that?
They've been kind of vague about the specifics, but they have said they're looking at staffing levels, trying to optimize their workforce. Some jobs will probably be eliminated, yeah, but they've also talked about retraining people, moving them into different roles where they can be more effective.
So it's a balancing act, trying to cut costs, but also invest in their employees. Hopefully they can make that transition smoothly. But it's not all about cutting costs. They're also looking for ways to make more money.
Oh, yeah, for sure. They're focusing on expanding their fee-based income, things like credit card fees, wealth management fees, and cash management services. They've launched a whole bunch of new products and services trying to entice customers with more options.
It sounds like they're being more strategic with how they offer those products too.
Yeah.
Instead of just hitting everyone with the same promotions, they're using data to figure out what customers actually need and recommending things accordingly.
Right. They want to be more like a trusted advisor, offering solutions that actually help their customers. Instead of just pushing products to make a quick buck, that kind of approach can really build customer loyalty over time.
It's a difference between a pushy salesperson and someone who's actually trying to help you. One leaves you feeling annoyed, the other makes you feel valued. But all these initiatives, even though they sound good, they take time to actually show results.
Right.
And investors, well, they're not known for their patience. So what's the timeline here? When can we expect to see some real improvements?
That's the big question. They've said that they think their operating expenses will only grow by about 13% next year, compared to 18% this year. But, whether they can actually hit that target and then go even further, well, we'll have to wait and see.
It's a high-stakes waiting game for sure. And of course, there's still that whole microfinance issue hanging over everything. We talked about what caused it, but now I'm curious about the solutions. How are they going to stop the bleeding and get that portfolio back on track?
So they've admitted they need to be a lot more careful about who they lend to. They've made their credit criteria much stricter, and they're being much pickier about who they approve for loans. They're also using this government-backed credit guarantee scheme for microfinance loans.
Oh, interesting. Tell me more about that.
Well, it lets them basically insure some of their new microfinance loans. So if someone defaults, they don't lose all the money. It helps spread out the risk a bit and hopefully limits how much they could lose in the future.
Smart. Like a safety net for their microfinance lending. But they're not just trying to prevent losses. They're also trying to improve the recovery rates on the loans they've already made, right?
Right. They're being tougher about collecting payments and exploring new ways to work with borrowers who are having trouble. It's a tough balancing act. They need to get their money back, but they also have to do it in a way that's not going to make things even harder for the borrowers.
It's a tough situation all around. But it at least sounds like they're moving in the right direction. They've acknowledged the problem, they're taking action to fix it, and they're being open about the challenges.
Yeah, that transparency is important, especially if they want to build back trust with investors. They've been sharing a lot of data in their presentations, really giving investors a detailed look at what's going on.
One of the things that jumped out at me was how they're handling those microfinance loans. They're being really conservative, provisioning 75% for loans that are 90 days past due and 100% for those that are 120 days past due.
Right, that's important. It shows that they're not trying to downplay the situation. They're being realistic about how much money they might lose and setting aside enough capital to cover it. Taking that hit to their profits now will hopefully prevent any nasty surprises later.
So they're taking their medicine, basically. It's not going to be fun, but it's the responsible thing to do in the long run.
Exactly. And keep in mind, their other lending portfolios are doing well. Their credit costs for those are within expectations, which suggests that the microfinance issues are more of an isolated problem.
So it's not like their whole lending system is flawed. It's more like they tripped up in one specific area.
That seems to be the case. And beyond just fixing the problems, they're also still putting money into their tech and digital platforms, constantly updating their mobile app and online banking, making them more user-friendly and adding more features.
That's so important now. People want banking to be easy and convenient, And they'll switch banks in a heartbeat if they don't get the experience they want.
Right. And they're not stopping there. They're exploring new technologies too. Things like artificial intelligence and machine learning to help with risk management and fraud detection.
Like giving their systems a brain boost. And they've also mentioned trying out partnerships, especially with fintech companies. What's the thinking there?
It's a smart move, I think. Fintech companies are often the ones driving innovation in the financial world. By working with them, IDFC First Bank gets to tap into that expertise. And they don't have to build everything themselves. It helps them stay ahead of the curve and offer their customers the newest and best products and services.
So it's a win-win. Fintechs get access to a huge customer base, and IDFC First Bank gets access to cutting-edge solutions.
Exactly. It's all about playing to each other's strengths.
Okay, so we've talked about cutting costs, managing risk, investing in tech, and strategic partnerships. But at the end of the day, the big question is this. Can they keep up that crazy growth rate and also improve their profitability? Because right now, it seems like they're choosing growth over profits.
Yeah, it's a balancing act and a tough one. They still want that high growth, but they know they need to start delivering consistent profits if they want to keep investors happy.
It's that tightrope walk again, between ambition and sustainability.
And that's what makes this whole story so interesting. They have a lot of potential, but they also have a lot to prove. It'll be really interesting to see how they handle this next phase and whether they can actually deliver what they've promised.
All right, we've talked a lot about IDFC First Bank's plans and the challenges they're facing, but I want to get into the nitty-gritty now, the numbers. What do they actually tell us about how healthy the bank is financially?
Well, that's where things get really interesting. They broke down their business segments, showed the operating profit for each one as a percentage of their loan book. It's like, looking under the hood to see what's working and what needs some fixing.
Okay, I love a good car analogy. Give it to me straight. Where are they making money and where are they struggling?
Let's start with the basics. The lending business. That's retail loans, MSME, rural loans, corporate loans, everything except microfinance. They're making an operating profit of 4.7% on those loans.
So even with everything we've talked about, their core lending business is actually pretty profitable. It's like they've got this great engine, but there's this one part that's dragging it down.
Yeah, that's a good way to put it. And they're working on fixing that part, like we said. Now, their liability business, that's basically where they get their deposits. Their goal is to get their cost-to-income ratio for that down to 100%, meaning they wouldn't be losing money on those deposits.
So right now, it costs them more to get those deposits than they're making from lending the money out.
That's right. But it is getting better. Their cost-to-income ratio for that has been going down. And they think it'll keep improving as they get more deposits and their branches get more efficient.
It's like they're building this huge reservoir, knowing that eventually they'll be able to use all that water to generate power.
Exactly. Thinking long term. Now, there's one area that's doing really well for them, their credit card business. Their cost-to-income ratio for credit cards has already hit 100%, so they're breaking even.
Wow, that's impressive, especially since they haven't been doing credit cards for that long. What's the secret?
They've been going after a specific type of customer. People with higher incomes, good credit scores. Those customers tend to be less risky and more profitable. They're also using tech to make their credit card operations more efficient, keep costs down. They're even predicting that their cost-to-income ratio for credit cards could go down to 60% in the next few years. That would make it a very profitable business.
It seems like they're building up a bunch of these profitable parts of their business that will eventually make up for the losses they're taking on microfinance. It's a good strategy, diversifying like that.
Definitely. Not putting all their eggs in one basket, they're creating a more balanced and resilient business, one that can handle problems in any one area.
Okay, so we've got the core lending business doing well, credit cards booming, and the liability business getting better. What about the other things they do, like wealth management and cash management?
Those are still pretty new, so they're not making a ton of money yet, but they're important for their long-term growth plan. Think of it like planting seeds. They're hoping those will grow into profitable trees later on.
So they're building this whole financial ecosystem. But anytime you're ambitious like that, there are risks. They're investing in a lot of different things, and it's not a guarantee that everything will work out. What are some of the things that could go wrong?
Well, one risk is that they try to do too much too fast, spread themselves too thin. Especially with the problems they have with microfinance and that high cost-to-income ratio, they have to be careful not to overextend themselves. Another risk is that they underestimate the competition. The banking industry in India is super competitive. They've got to deal with traditional banks and all these new fintech companies.
So it's not just about what they do internally. They have to keep up with a market that's changing really fast. It sounds like they're walking a tightrope between being innovative and being careful.
Exactly. And how successful they are will depend on how well they can balance those two things. They have to be brave enough to invest in new ideas and technology, but also smart enough to manage risk and use their money wisely.
All right, so we've looked at their strategies, their numbers, their overall vision. What's the bottom line? What should we make of IDFC First Bank?
It's a company in transition, trying to navigate a really complex market. They're ambitious, their core business is solid, and they're willing to try new things. But they also have some serious challenges that could hold them back.
They're building that plane while it's in the air. Now they have to prove they can not only keep it flying, but make it soar.
Perfect analogy. Their success really depends on whether they can put their plans into action, manage risk, and adapt to the changing banking industry.
It's a story that's still being written. We've given our listeners all the info, but it's up to them to decide whether or not to invest in IDFC First Bank.
Right, we've laid it all out there, the knowledge, the analysis. But ultimately, each investor has to decide for themselves. Weigh the risks and the rewards. Make a decision that fits their own goals.
And that's what the deep dive is all about, giving you the information you need to make informed decisions.
So do your research, stay informed, and as always, happy investing.
That's it for this episode of The Deep Dive. We'll be back soon with another deep dive into a fascinating company or trend. Until then, keep exploring, keep learning, and keep diving deep.